indication of how affordable or how expensive options are right now. It is a percent value, and it's always relative to the current close price of the underlying of the symbol. Okay, so what we'll do, and I'm going to look at the calculations, we look at, hey, this is the current option price, and we're going to divide that price by the price of the symbol itself to get a percent value. And if that value is very, very low, like 1.55, it means the options right now are extremely cheap. And the SPY, I've been not very volatile, and the SPY options are extremely cheap right now. The VIX, if you look at the VIX right now, it peaked to 20 at some point, I think on Friday or Thursday. Now we're down to 16. It was very low. Options are very cheap right now for the SPY. But of course, some symbols have expensive options. Gold, for example, an index or a heat index of 8.82. That's expensive. Yeah, it's close to 10. If you're an option seller, if you believe in gold, you believe that the uptrend is going to continue, I want to collect some premiums, well, maybe selling cash secured puts or any other option strategy for GLD, maybe not the worst idea. Silver, 13.45, very expensive. Extremely expensive. So this is what I did on Monday. I sold SLV options, which are now nicely in the profit because they were extremely expensive. And also, of course, you collect a big premium. And if the underlying, of course, stays above the strike price, you get to keep the entire premium. So that's for option sellers something very interesting. And of course, there are in-betweens too, like Amazon, for example, a heat index of 4.33, somewhere in the middle. Not super cheap, not super expensive. It's kind of an average value. So this allows you to filter for these opportunities. All right. Now, real quick, what is the calculation? And for those of you who are not interested in this, please don't listen. Maybe take a little coffee break for 1 minute because this slide is a little bit complicated to consume. But if it's just something for behind the scene, the main takeaway is this table here. What is considered a very cheap option or perhaps a very expensive option, anything in between. That's the key takeaway. Now, how is this calculated? Well, first off, it's a synthetic value. It doesn't exist in the real world. It's something that we do based on our own calculation. Yeah? Using a technique, a mathematical technique called interpolation. Yeah. It's a very simple technique to be used. And what we do is because we want to normalize this value as much as possible. So we're thinking, how can we do this? Well, first off, what we do, and we use a similar approach as the VIX does, we are looking at the money options, all options, with 30 days expiration. Similar to what the VIX does. If you look at the VIX index, it also checks at the money options with about 30 days expiration. Okay, so that's what we do as well. Okay, but we want to normalize it. So let's say, for example, the price of IBM, let's say, hypothetically, is 121.82. There are no strike prices at 121.82 for IBM. It's impossible. They're always at even numbers most of the time. Okay, so what we do is actually we are calculating a hypothetical option value or cost for exactly this fractional price, strike price, using interpolation. So we don't go down to the lower one at 121 or to the higher one at 122. We actually calculating the hypothetical value for 121.82. Okay, that's what we do in the calculation. Secondly, sometimes we also want to calculate the option price with exactly 30 days to expiration. But sometimes there's weekends involved, there are holidays involved. Sometimes the options only expire weekly. It's not always exactly 30 days out. But what we do in our calculation, we actually, once again, using interpolation, simulate or calculate the price. What if there was a date exactly 30 days out? What would the option price approximately be? So that's exactly what we do. So it's a synthetic value, doesn't exist in the real world, but we do this to normalize this, the value that you get as much as possible to be exactly with the underlying price, 121.82, and exactly at 30 days expiration. And then the second step is actually super, super simple. We divide this value by the price of the underlying to get this percentage value that you have seen. All right, now let's go through two use cases real quick. Use case number one, what you can do with this heat index. You can find options which are currently affordable. If you are interested in a long option strategy. If you're an options buyer, this could be a long call strategy where you just buy call options, or a long put strategy, perhaps a long strangle or straddle, or anything that involves buying options. Because for this, you can just simply sort from lowest to highest to find which options right now are the most affordable. Then potentially invest into those, anticipating, okay, that's very cheap right now. Maybe options prices are going to go up and volatility picks up for these symbols, for example. That's use case number one. Use case number two is you want to find expensive options right now if you are an option seller. Now, I like to sell cash secured puts, especially for symbols I really believe in, like the SPY, which are very cheap right now. I haven't done it in a while, or perhaps gold and silver. Yep. Then you want to find options which are currently very expensive because you want to sell high and buy back low. So these are the two main use cases. And then the kicker, if you combine this, with key technical levels, then the rubber really hits the road, because then you can find a key technical setup. You have a good prediction of what price might be doing in the medium-term future and when price will be. And then you can find the right option strategy based on the current heat index. I'm going to give you an example of how this can work. So I'm going to go back to the dashboard. And what we're going to be doing today is the following. So let's do a quick scan. I want to only consider stocks with daily or weekly expirations. So we're down to 521 stocks. We already know it in our universe, just to make sure we are liquid. And the first thing, because we don't talk about very much, is we want to potentially look for a short trade this time. It might be, typically we always go long because, I kind of don't like to short stocks in general because the upside risk is could be potentially unlimited. But with options, this doesn't have to be the case. So maybe I want to be a buyer of put options, but of course I want to buy them cheap. So I'm going to put my heat index filter to be less than 3%. Well, it's a fairly low value. Now we're down to only, can see it here, to 104 stocks. All right. And if we want to potentially look for a short setup, I want to focus on stocks which are currently in a bearish trend. Bearish here, 19 stocks remaining. And lastly, let's line up these setups also with a key technical setup. A short bounce, for example, with Liquidity IQ. We're down to 3. All option prices are very cheap. For example, here, PepsiCo. Look at this one here. It jumped up to a key technical level. Right here at resistance, a stock which has been bearish for quite some time, since November 2024. If you're now anticipating, okay, I think Pepsi will bounce off this level towards lower price levels, I wanted to do a risk-limited trade, buying put options. Now could be an interesting opportunity because the heat index for Pepsi is only 2.35. Options are cheap right now. Huh? Another example, Verizon, up here, VZ. Look how it jumped up to key support. Options are even cheaper at 2.30. At key support here, we are bearish. If you are anticipating, okay, we're gonna, bounce up this level to the lower price levels, maybe buying puts right now, not the worst idea because options are very inexpensive. This is how you can use this heat index to find interesting options trade. This will be for option buying, because this also works for buying calls. Let me just quickly look for if there's any buying call opportunities here. So I'm going to go for bullish stocks now. Bullish, currently at, let's say, a long bounce setup. Visa, look at this. What's going on with Visa? 1.15 heat index, extremely low. The options are very, very cheap here in Visa. Gas prices have been just very sideways here. Potentially, if you think that Visa might be jumping up, maybe looking into buying some calls for Visa. Not the worst idea. Okay. Now, what about selling options? Which stocks right now potentially have expensive options, maybe for cash secure puts, which is a long play? Let's try it out. So I'm going to switch it up here. I'm going to say, hey, I want to see the options which currently have at least, let's say, maybe more than 10% premium on the 30 days expiration. I sort this by date here. And the first one that comes up is potentially Coinbase. 10.19, even though I would not do this with Coinbase because I think it's going to go further down to this level here. So maybe a bit too early. D-Wave Quantum. Yeah, nice pullback here. If you believe in Quantum, maybe D-Wave is the player here. And I want to sell some expensive premiums. Yeah, maybe this one could be an interesting one. We're bullish for 200 trading days. You can see the bullish sign here. Bullish for a while, coming down to key support, and premiums are high at 12.17 compared to the stock price. And the price of the underlying is actually not too expensive, so you don't have to, even if you get a sign, this would be still and a reasonable value, which probably would not blow out your account. So I hope this explains a little bit how this can be used, this new index can be used to identify interesting option trading opportunities.